ETFs, or exchange traded funds, are one of the most popular and easiest ways to get invested in the financial markets today. But here is the problem. A lot of people invest in them blindly. They may have seen or heard individuals online recommending these ETFs. And just like that, they hit buy without realizing that there are hidden details that can either make or break their returns. If you're considering starting your investment journey via ETFs, here are 10 things you need to know before buying any ETF. I'll cover the essential checks that you should never skip so that by the end of this video, you'll know exactly what to look out for so you can invest with confidence and avoid costly mistakes. And all of these 10 points are information or data sets that you can easily find online, but I'll show you precisely where to find them, so make sure you watch until the end. So first off, what is an ETF? An ETF, or an exchange-traded fund, is an investment fund that holds multiple underlying assets in one convenient product. And so instead of buying hundreds or even thousands of different stocks, you can get a slice of each of those companies in one product. The first thing you need to know before buying an ETF is its market or region. Did you know that many of these so-called global ETFs are actually US heavy, sometimes with up to 70 to 72% of their holdings in American stocks? So when you buy these global ETFs, you might think you're getting good diversification across regions, but in the end, you really aren't. According to a recent report by Fidelity, the MSCI World Index has about 72% of its money invested in American stocks and about 28 to 30% allocated to the rest of the world. But spreading your investments across regions like Europe, Asia, emerging markets not only cushions you against region-specific downturns, but it also opens the doors to growth cycles happening elsewhere. So before buying an ETF, you need to decide on the market or the region you would like to be exposed to. If you wanted exposure to the US markets, you would need to find an ETF that tracks either the S&P 500 or the Nasdaq. If you wanted exposure to Europe, for example, you might want to invest in an ETF that tracks the Stocks Europe 600. To get exposure to the UK, you would want to consider an ETF that tracks the FTSE 100. And if you wanted exposure to emerging markets, you would want an ETF that tracks the MSCI Emerging Markets Index. So always check the geographical breakdown of your ETF. Don't just trust the word global. Always ask, what exactly is my money exposed to? Next, and one of my personal favorites, dividends. Yield does not always mean quality. Some ETFs might boast high yields. For example, the Investco KBW Premium Yield Equity REIT ETF, that's a mouthful, currently has a yield of around 9%. But that can come with increased risk because some companies might push payouts in order to attract investors and later disappoint with cuts. The second thing you would want to know about dividends where ETFs are concerned is whether the ETF is distributing, i.e. it pays out dividends to you as an investor, or whether it is accumulating, which means that it reinvests your dividends on your behalf. Depending on how you are investing, whether you are using a normal brokerage account or perhaps using a tax-efficient account, these will have impacts on your tax considerations, and it also matters in terms of your income preferences. So for example, are you an investor who would rather receive these dividends, or are you an investor who wants to reinvest your dividends to grow your positions and your fund over time? So before investing, be sure to check out how the ETF treats dividends. The third thing that you would want to know before buying an ETF is who the asset manager is. A lot of new investors, understandably, may buy ETFs based on what they've seen or they've read online without even asking who's managing my money. And you might ask, well, does it really matter? It does, because not all asset managers are created equal. Asset managers are really the brains behind these ETFs. They are the professionals who decide on how to allocate investments, how to manage risks, and how to execute their strategy to grow your money over time. For example, if you invest in an active ETF where the managers are responsible for actively choosing or picking each individual holding within the ETF, as opposed to purely tracking or following an index, which would be a passive ETF, you would definitely want to know who's managing the funds and ultimately managing your money. Because here's the thing, although there are over 14,000 ETFs globally, the markets can be highly concentrated, with the top 3 managers accounting for a combined 74.3% of the entire equity ETF market. And so before investing your hard-earned money, you would want to dig into who's managing the fund, what is their track record, especially with active ETFs, and what is the fund performance. Because the asset manager isn't just a name on paper, it can really break or make your ETF investing experience. The next thing you would want to know before buying an ETF is its fees, or its TER, its total expense ratio. The TER, or the total expense ratio, is the annual percentage of your investment that will be paid to the fund to manage the fund on your behalf. And this will cover things like management fees, administrative fees, auditing fees, custodial service fees, and others. And it happens to be one of the most accurate gauges of cost drag on your investment. So for example, if you invest $10,000 into an ETF with an expense ratio of 0.04%, you'll pay $4 to the fund manager. Last year, the average index equity ETF had a TER of 0.4%, while bonds stood at 0.2%. And so using this data, if you invest $10,000 into an ETF with a TER of 0.4%, you'll be paying $40 to the fund manager. A lower total expense ratio means that more of your money stays invested, and that's what builds wealth. The next thing you would want to know is the size of the fund. Scale often brings stability, because once an ETF crosses a certain threshold, its profits grow faster than its costs. And this allows fund managers some flexibility around perhaps reducing the fees, but also improving longevity of the fund. So the larger ETFs can oftentimes enjoy what's called economies of scale, because they can enjoy tighter bid-ask spreads, which means they enjoy improved pricing on stocks, bonds, etc. But it also reduces the risk of the fund shutting down unexpectedly. So yes, size does matter, but bigger doesn't automatically mean better returns. While larger ETFs can offer reliability and some peace of mind, performance still depends on the underlying strategy they track. Next is its benchmark. The benchmark determines the assets that the ETF will track: stocks, bonds, commodities, currencies, etc. Or put another way, the benchmark is the yardstick, typically an index that the ETF will look to either match or beat. So for example, the S&P 500 for large cap US stocks, or the Bloomberg Aggregate Bond Index for broad US bonds. Without knowing the benchmark or even having the right benchmark, how do you know whether your ETF is doing its job, or whether it's leaving returns or even risk on the table? When you compare an ETF's returns to those of its benchmark, there are 2 things you'll notice. The first one is how well it's tracking the underlying market, and number 2, whether it's doing so at an appropriate level of risk or volatility. If your ETF returns 8% and the benchmark returns 12%, that's an underperformance. And if it is fairly volatile, it means that you are taking on quite a bit of risk without an appropriate level of compensation in way of returns. And so the question you should always ask is, what is the benchmark and how is the ETF doing relative to its benchmark? The next thing you would want to know is the fund's UCITS status. The term UCITS stands for Undertakings for Collective Investment in Transferable Securities. So this was a regulatory framework that was launched or introduced across Europe to ensure that investment funds were diversified, they were liquid, they were transparent, and it was essentially aimed explicitly at safeguarding retail investors. A major perk with UCITS ETFs is that they are required to limit single holdings. So for example, they are typically mandated to hold no more than 10% of the fund's assets in one single issuer. And this is good because it helps maintain strong portfolio safeguards. Oftentimes, when ETFs don't comply with UCITS rules, they can expose investors to hidden risks. Related to the last point, the next thing you would want to know about your ETFs are whether they are specialty ETFs or leveraged ETFs. Specialty ETFs aren't your run-of-the-mill ETFs. Unlike traditional ETFs that may track major indices, for example, the S&P 500, specialty ETFs tend to focus on niche areas or particular industries like technology, energy, or even specific commodities like gold, precious metals, oil, etc. Or they may have unique investment strategies like inverse or leveraged exposure to an index. So leveraged ETFs essentially magnify the gains as well as the losses of normal indices, and they are much riskier with higher potential returns as well as losses. While inverse or short ETFs follow the opposite direction of the reference or the underlying index. And so prior to investing in these specialty or leveraged ETFs, it's important to understand the risks as well as the mechanisms behind them. Next is the structure of the ETF. ETFs can be either physical, meaning that they own the underlying assets of the index that they track, for example, stocks, bonds, commodities, currencies, or it can be synthetic, which means it doesn't actually own the underlying assets. Instead, it uses a derivative like a total return swap with a counterparty to replicate the index returns. Now, here's where it gets interesting. Synthetic ETFs can actually offer lower fees, and they can do a better job of tracking the underlying index or benchmark because they sidestep the hassle of having to buy dozens or hundreds or even thousands of individual securities. But there is always a catch, and here it is. These synthetic ETFs are exposed to counterparty risk. So if the entity that they've entered into these derivative arrangements or the total return swap with can't deliver, your ETF could be affected even if the underlying index is up. And as I mentioned before, synthetic ETFs are more common in Europe, with around 16% of ETF assets being synthetic. But in the US, they are very rare, with around 1% of the total ETF market. And so before investing, you should always check the structure of the ETF, know whether it owns the underlying assets and is a physical ETF, or whether it relies on a counterparty to deliver the returns and is a synthetic ETF. Next is hedging. So first off, what is a hedge? A hedge is an investment that's made with the intention of reducing potential losses of an underlying or existing portfolio. And the way a hedge works is that it takes the opposite direction of an existing investment within your portfolio. When you buy a foreign or overseas ETF or an ETF that has exposure to international assets, you are taking two bets. One of those bets is on the performance of the underlying asset itself, and the second bet is on foreign exchange rates. In a scenario like that, if the ETF is hedged, what that means is that it uses foreign currency forward contracts to neutralize any FX risk. However, if the ETF is unhedged, it leaves you exposed to currency movements. All through my career, I used a lot of hedging to protect the value of my clients' assets. And this was because we made quite a significant amount of international investments. If your base currency or your home currency or operating currency is the US dollar, for example, and the US dollar happens to be strong, this is where hedged ETFs really shine. So before you buy an international ETF, you need to ask yourself, do I want to be exposed to gyrations or swings in the FX rate? Or do I just want to partake in the performance of the underlying asset or index? If you want to be protected against swings in the FX rate, you more likely would want to consider a hedged ETF. But if you don't mind exposure to movements in FX rates, positive or negative, then you might want to consider the unhedged version of the ETF. For those who might still be struggling with just how a hedge works, let me use an example to bring this home. Let's say that your base currency is US dollars and you have 10,000 US dollars to invest in an international ETF that follows the European markets or has exposure to the euro as a currency. What happens is that the ETF takes your US dollars, converts that to euros to buy European assets. When the ETF comes to sell those assets or perhaps receives dividends from those assets, it needs to convert it back to USD to return to you as the investor. If at the time the asset is sold or those dividends are received, the US dollar is stronger than the euro, it means that you are paying more euros per US dollar, which means you lose out a little bit of your returns from the currency exchange. So what a hedge does in this case is that if the managers of the ETF believe that the US dollar is going to be stronger in the future, they lock in a price today for the future, meaning that when they convert your euros back to dollars, you pay the lower rate, which means that you keep more of your returns. I don't want to confuse you or make this too complicated, but I hope that gives you some insight or color into how hedges can protect both your returns and the value of your investments. We've covered quite a bit today, and you might be wondering, well, where do I find all of this information? The great news is that it is all online and it's all free to access. You can access this information via your broker's website on the ETF page or through websites like iShares.com, which will have information on all of the ETFs listed on that site, or by reading through the ETFs on prospectus or fact sheets. All of the information will be detailed. If you're new to investing, I posted a detailed video on 3 of the most popular and easiest ways to get invested in the financial markets: ETFs, index funds, and mutual funds. And I also discuss which one of these might be the best option for you. And you can watch that video next here.